Broadcom has emerged as one of the most compelling yet controversial stocks in the artificial intelligence revolution. The company's stock has surged nearly 60% year to date, significantly outperforming major competitors like Nvidia and AMD. This remarkable performance stems from Broadcom's strategic positioning in the custom AI accelerator market and its successful integration of VMware. However, with the stock now trading at premium valuations that have many investors questioning sustainability, we need to examine whether Broadcom represents a continued growth opportunity or a cautionary tale of market exuberance. The semiconductor giant has fundamentally transformed from a traditional chip company into an AI infrastructure powerhouse. Its third quarter fiscal 2025 results showcase this transformation with record revenue of $16 billion, representing 22% year-over-year growth. More importantly, AI semiconductor revenue reached $5.2 billion, marking 63% year-over-year growth and extending a remarkable streak of 10 consecutive quarters of robust AI-driven expansion. The most significant catalyst for Broadcom's recent surge has been the revelation of a massive partnership with OpenAI. During the third quarter earnings call, CEO announced that a fourth customer had joined Broadcom's exclusive custom AI accelerator program, securing over $10 billion in orders for AI racks based on Broadcom's XPU technology. Industry sources later confirmed this customer to be OpenAI, the creator of ChatGPT and arguably the most influential AI company in the world. This partnership represents more than just revenue for Broadcom. It validates the company's thesis that major AI players need custom silicon optimized for their specific workloads rather than relying solely on general-purpose GPUs. OpenAI's decision to work with Broadcom addresses their enormous computational demands while reducing dependence on Nvidia's expensive and generalized AI accelerator offerings. The economics behind this move make compelling sense. Training AI models require massive computational power, but occurs episodically. Inference, where models apply their learning to make predictions and serve users, happens continuously and at enormous scale. Custom inference chips designed for specific model architectures can deliver 3 to 5 times better performance per watt than general-purpose GPUs. When operating at ChatGPT scale, these efficiency improvements could save tens of billions in annual operating costs. OpenAI has already secured manufacturing capacity with TSMC for their first custom designed chip, expected to launch in 2026. This $10 billion initial order represents just the beginning of what could become a transformative relationship for both companies. Broadcom's XPU business has become the crown jewel of its AI strategy. It represents 65% of company's AI revenue in the third quarter. The company serves what CEO describes as a highly selective market of companies developing frontier AI models. These customers require massive computational resources for both training increasingly sophisticated models and for deploying them at scale for inference. Prior to OpenAI, Broadcom worked with 3 major hyperscale customers widely believed to be Google, Meta, and ByteDance. The addition of OpenAI as a fourth customer significantly diversifies this customer base while validating the growing demand for custom AI solutions. Each customer is on their own journey towards compute self-sufficiency, progressively increasing their usage of custom XPUs with each generation. The custom ASIC market represents a fundamental shift in how AI infrastructure is being built. While the overall AI chip market is projected to grow at a compound annual growth rate of 31% to reach $341 billion within 7 years, custom AI accelerators are capturing an increasingly larger share. Industry analysts project the custom segment could exceed initial projections of 10 to 15% market share by 2030, potentially capturing a much larger portion of the overall market. Broadcom's position in this market appears increasingly secure due to high switching costs and the technical complexity of developing custom silicon. When a hyperscaler commits to a custom ASIC partner, the switching costs extend far beyond financial considerations to include time to market delays and operational risks. This creates significant barriers to entry for competitors and provides Broadcom with durable competitive advantages. Beyond custom accelerators, Broadcom's networking business represents another critical growth driver in the AI infrastructure build-out. As AI clusters scale beyond 100,000 compute nodes, networking becomes the primary bottleneck determining system performance. The company's Ethernet-based networking solutions are becoming essential as data centers require unprecedented bandwidth and low latency communications. Broadcom recently launched its Tomahawk 6 networking switch, operating at 102.4 terabits per second. This innovation flattens traditional 3-tier data center networks to just 2 tiers, reducing latency by 40% and power consumption by 30%. For massive AI training clusters, these improvements represent the difference between feasible and impossible scaling. The company has also introduced its Jericho 4 Ethernet Fabric router designed for clusters spanning multiple data centers. As AI training requirements grow beyond what single data center locations can support, these cross-data center networking solutions become critical. The Jericho 4 handles clusters beyond 200,000 compute nodes across multiple locations, enabling hyperscalers to create homogeneous computing environments spanning vast geographical areas. AI-related networking revenue is growing at over 40% annually and could reach $15 billion by 2027. Despite this growth, the market continues to treat this as a commodity networking business rather than recognizing it as a critical AI infrastructure with limited competition. The acquisition and integration of VMware has proven to be another significant success story for Broadcom. The infrastructure software segment, which includes VMware, reported 17% revenue growth to $6.8 billion in third quarter, exceeding previous guidance. More importantly, the segment achieved gross margins of 93% and operating margins of 77%, representing substantial improvements from 67% operating margins achieved a year ago. CEO Hock Tan highlighted the release of VMware Cloud Foundation version 9.0 as a major milestone. This fully integrated cloud platform enables enterprises to run any application workload, including AI workloads across private and public cloud environments. The platform represents a genuine alternative to public cloud services, addressing the growing enterprise demand for hybrid cloud solutions. The successful transition of VMware from a perpetual license model to a subscription-based business has created a new recurring revenue stream for Broadcom. Over 90% of the top 10,000 VMware customers have now purchased VMware Cloud Foundation licenses, though full deployment across their infrastructures represents the next phase of growth over the coming years. The hybrid cloud market presents substantial long-term opportunities. While market size estimates vary significantly, ranging from $45 billion to $134 billion currently, with projected growth rates between 17% and 21% annually through 2034. VMware's established position provides Broadcom with exposure to this expanding market. Despite strong fundamentals and growth prospects, Broadcom's valuation has reached levels that give even bullish investors pause. The stock currently trades at approximately 49 times forward earnings, representing a significant premium over the semiconductor sector median of 29 times. This compares to Nvidia's forward price to earnings ratio of 38 times, meaning Broadcom now commands a 35% valuation premium over the AI market leader. The company's forward price to sales ratio of 24.84 times, while justified by strong growth prospects, represents a substantial premium to historical medians. Even using a PEG ratio analysis, which accounts for growth expectations, Broadcom trades at 1.28 times, approaching the upper end of what growth investors typically consider fairly valued. On a price to free cash flow basis, Broadcom looks expensive as well, with a ratio of nearly 65, far above its long-term medians. By some measures, its earnings multiple is even higher than Nvidia's despite slower top-line growth. Yet the company's profitability metrics are among the strongest in the industry, with free cash flow margins above 40% and adjusted EBITDA margins above 60%. Analysts also forecast rapid earnings and cash flow growth in the coming years, which could allow Broadcom to grow into its valuation. Projections call for EPS growth of 38%, 36%, and 28% in the next 3 fiscal years, alongside significant free cash flow expansion. In short, while Broadcom looks expensive today, the market is pricing in exceptional growth potential, particularly from AI. The market has clearly priced in substantial future growth expectations. If Broadcom continues executing on its AI opportunities while maintaining current valuation multiples, the stock could theoretically reach 500 or higher by 2027. However, this scenario requires flawless execution and continued market expansion at projected rates. While Broadcom enjoys a dominant position in custom AI accelerators, competition is increasing. Marvell Technology has secured custom AI accelerator design wins with Microsoft and Amazon Web Services, representing direct challenges to Broadcom's customer base. AMD is leveraging its GPU expertise to compete for custom designs, while numerous startups are receiving substantial funding to challenge Broadcom's dominance. The competitive landscape extends beyond traditional semiconductor companies. Major cloud providers are now increasingly developing their own in-house chips to reduce dependence on external suppliers. Amazon has developed Trainium and Inferentia processors, while Google continues advancing its TPU architecture. If Broadcom's current customers decide to bring more chip development in-house, it could significantly impact future growth prospects for the firm. Chinese restrictions present another risk factor, potentially affecting approximately 10% of Broadcom's AI revenue. While the OpenAI partnership more than compensates for potential ByteDance losses, ongoing geopolitical tensions could create additional challenges. The rapid pace of hardware acceleration in AI creates inherent risks for application-specific integrated circuits. While GPUs have broad applications across multiple use cases, ASICs are designed for specific functions. If AI inference requirements change dramatically, custom chips could become obsolete more quickly than anticipated. A significant concern for Broadcom investors is continued weakness in non-AI semiconductor businesses. These segments, including broadband, server storage, and enterprise networking, have yet to show meaningful recovery from the downturn that began in fiscal 2023. CEO Hock Tan characterized the recovery as U-shaped rather than the V-shaped recovery typical of semiconductor cycles. The lack of diversification creates concentration risk in AI-related revenues. Most of Broadcom's growth currently depends on AI semiconductors from a select group of hyperscale customers. If anything threatens AI semiconductor growth before the non-AI businesses recover, the potential impact could be severe. Management expects a more meaningful recovery in non-AI semiconductors by mid-2026 to late 2026, but uncertainty remains high. The only segment showing consistent strength is broadband, which had been most severely impacted during the previous downturn. Broadcom's financial metrics demonstrate the operational leverage inherent in its business model. Third quarter adjusted EBITDA reached $10.7 billion, representing a 67% margin and 30% year-over-year growth. Operating margins improved to 65.5% despite revenue mix changes. This showcased the company's ability to scale efficiently. Free cash flow generation remains impressive, with third quarter cash flow of $7 billion, representing 44% of revenue. Trailing 12-month free cash flow of $24.93 billion provides substantial resources for research and development, acquisitions, and shareholder returns. Management's fourth quarter guidance projects continued acceleration, with total revenue expected to reach $17.4 billion, representing 24% year-over-year growth. AI semiconductor revenue is projected to grow 66% year-over-year to $6.2 billion, indicating continued momentum in the core growth driver. Looking beyond the fourth quarter, management has indicated that fiscal 2026 AI revenue growth will accelerate beyond the 50 to 60% rates seen in fiscal 2025, largely driven by the OpenAI partnership and expanded relationships with existing customers. A crucial factor in Broadcom's investment thesis is the continued leadership of CEO Hock Tan, who announced his commitment to remain as CEO through 2030. Tan has orchestrated the company's transformation from a traditional semiconductor business to an AI infrastructure leader while successfully integrating major acquisitions like VMware. Under Tan's leadership, Broadcom has demonstrated remarkable discipline in capital allocation and strategic vision. The company's approach to the AI market, focusing on a select group of customers with substantial long-term commitments rather than pursuing broader market opportunities, reflects this strategic discipline. The announcement of Tan's extended commitment provides investors with confidence in continued strategic direction, during which he described as exciting times for Broadcom. This leadership continuity becomes increasingly important as the company navigates the complexities of rapid AI market evolution. Broadcom presents a compelling yet complex investment proposition. The company has successfully positioned itself at the center of AI infrastructure build-out, with custom accelerators and networking solutions that have become essential for hyperscale AI deployments. The OpenAI partnership validates this strategy while providing substantial near-term revenue visibility. However, the stock's valuation has reached levels that require near-perfect execution to justify current prices. At nearly 50 times forward earnings and substantial premiums to historical metrics, Broadcom offers limited margin for error. The concentration of growth in AI-related businesses, while currently advantageous, creates risks if market dynamics shift unexpectedly. For investors who believe the AI infrastructure build-out is still in early innings and that Broadcom can maintain its competitive advantages, the stock may continue delivering strong returns despite current valuations. The company's strong financial metrics, recurring software revenues, and expanding customer base support optimistic scenarios. Conversely, investors concerned about valuation multiples and execution risks may prefer to wait for more attractive entry points. The stock's rapid appreciation has pulled forward much of its upside potential, potentially limiting near-term returns even if fundamentals continue improving. The ultimate investment decision depends on individual risk tolerance and conviction in Broadcom's ability to execute its AI infrastructure strategy. While the growth opportunity remains substantial, the price paid for that growth has reached levels that demand careful consideration of both upside potential and downside risks. As Broadcom continues navigating the AI revolution, investors must weigh the company's undeniable technological advantages and market position against valuations that leave little room for disappointment. The next several quarters will be crucial in determining whether current prices prove sustainable or excessive. Thanks for watching. Have a great day.